Welcome to this explainer. Look, if you think counting boxes in a warehouse is just some boring chore for the operations team, well, you're in for a massive surprise today. We are about to turn dry accounting into the absolute secret lever that controls your business's bottom line. Seriously? Could the way you count your inventory be secretly altering your profits? It's a huge question. Managing your physical stock and calculating its financial value are two completely different games. You could literally have the exact same number of items sitting on your shelves, but the math you choose to value them can drastically change how much money you tell the government you made, and obviously how much you have to pay in taxes. And the stakes are incredibly high right from the jump. Did you know the average retailer loses about 1.6% of their sales to inventory shrinkage? We're talking theft, errors, and damage. That is cold hard cash vanishing directly from your profit margin before we even start doing the accounting math. So, choosing the right inventory method is absolutely crucial for tracking those losses and locking in your profitability. So, here's our roadmap for today. We're going to cover 1. Tracking systems, 2. Valuation methods, 3. Running the real numbers, 4. Financial impact, and finally, 5. Making the choice. Let's kick things off with Section 1, Tracking Systems, Perpetual versus Periodic. Okay, let's dive into how we physically track stock, keeping one golden rule in mind: inventory is cash. We basically have two ways to do this. On the left, perpetual systems give you real-time stock visibility using software, barcode scanners, or RFID tags. It automatically updates every single time a transaction happens. On the right, the periodic system relies on manual counts at set intervals, like, say, the end of a month or year, usually with just a spreadsheet and a clipboard. It's definitely cheaper to set up, but it leaves you totally blind to your actual stock levels between those counts. Now, this physical tracking directly impacts a massive line item on your income statement, your COGS, or cost of goods sold. The formula is simple: beginning inventory plus your purchases minus your ending inventory. In a periodic system, you only calculate your COGS at the very end of the period when you manually count everything. But a perpetual system, it updates this formula automatically with every single transaction, giving you instant financial visibility. Moving right along to Section 2, Valuation Methods, FIFO, LIFO, and WAC. Now that we know how to track it physically, let's look at the math. First up, we have FIFO. That stands for first in, first out. It assumes your oldest inventory goes out the door first. It makes perfect logical sense, right? Especially if you're selling perishable goods. Financially, it means your older, usually cheaper, inventory costs are matched against your current revenue. This leaves your newest, often more expensive inventory sitting pretty on your balance sheet. If you look at the physical process in a warehouse, it's super meticulous. You use a store ledger. Whenever the team gets new goods, they record the receipt, literally draw a line in the ledger, copy the old balance down, and place the new items right below it. When it's time to send items out, you strictly issue out that oldest lot first to keep the chronological costs perfectly aligned. Next up is LIFO, or last in, first out. And honestly, this is where things get really fascinating, because it's the exact opposite. It assumes the newest items you bought are the first ones sold. Under LIFO, your most recent, highest costs are expensed against your revenue first. Meanwhile, those older, cheaper items just remain theoretically untouched on your balance sheet. And finally, there's the weighted average cost method, or WAC for short. This one simply smooths out price fluctuations by mathematically averaging all your available units. Every time you buy new inventory, you divide the total cost of goods available by the total units. It's a really practical middle ground, especially for e-commerce sellers pushing high volumes of identical items, where tracking specific individual batches is just way too complex. All right, Section 3, Running the Real Numbers. Let's see how these methods create totally different financial results using the exact same physical sales. Imagine a manufacturer in Durban buying steel in two batches, one batch at 30 Rand per kilogram and a later batch at 35 Rand. They then sell 400 kilograms. Look at the difference here. With the exact same purchase history, FIFO gives a cost of sales of 12,500 Rand. Weighted averages in the middle at 12,800, but LIFO, it hits 13,000 Rand. Literally just by changing the accounting method, the cost of goods sold jumped by 500 Rand. And this brilliantly illustrates the impact on profit. Let's say an electronics retailer sells 150 Bluetooth speakers for $3,750. Because their wholesale costs rose from $10 to $15 over a few months, their gross profit completely shifts. Under FIFO, they show a healthy gross profit of $2,150, But under LIFO, because those newer $15 costs are recognized first, the gross profit drops to just $1,650. It's wild. Which brings us to Section 4, Inflation, Taxes, and Reserves. So why does this valuation debate even matter? Well, it really only kicks in when prices are changing, specifically during inflation. If prices always stayed perfectly flat, FIFO and LIFO would give you the exact same result. But in the real world, costs go up. During inflation, FIFO creates higher reported profits. LIFO, on the other hand, deliberately minimizes your reported profit. Why would a business want to look less profitable? Simple, to reduce their immediate tax liability. Now, looking neutrally at the regulations, there is a fascinating global divide here. In the US, GAAP permits both FIFO and LIFO. However, the IRS enforces a strict LIFO conformity rule, meaning if you use LIFO to lower your taxes, you absolutely must use it on your financial statements for investors too. But here's the catch. International Financial Reporting Standards, or IFRS, completely ban LIFO. They argue it often doesn't reflect the true physical flow of goods and can seriously understate your balance sheet. To bridge this gap and keep things transparent, companies using LIFO use what's called a LIFO reserve account. Think of it as a balancing ledger. It explicitly shows investors the mathematical difference between their LIFO calculations and what the value would have been under FIFO. It essentially reveals exactly how much inflation is altering their inventory value, maintaining total transparency while still legally securing those tax benefits. And that leads us to Section 5, making the right choice. With all this theory and math, how do modern multi-channel sellers actually implement this? Well, sometimes they don't just pick one. A real-world e-commerce brand selling on Amazon and Shopify solved this beautifully. Faced with massive freight inflation, they adopted a LIFO for their official tax reporting to save big on their tax bill. But internally, for making smart pricing and marketing decisions, they maintained FIFO so they could understand their true operational performance. They practically got the best of both worlds. But remember, your strategic choice entirely dictates your tech stack. If you decide to go with FIFO, systems like QuickBooks Online natively support it. However, if your business runs on Xero, you need to know it defaults to average costing. If you want strict FIFO or LIFO in Xero, you'll likely need specialized third-party inventory add-ons. Your software has to be capable of running the exact math you choose. This leaves us with one final, absolutely crucial question for your own operations. Is your software working for you, or is your business secretly bleeding margin simply because you chose the wrong math? Thanks for joining me on this explainer today. Honestly, it might be time to go check your ledger. See you next time.